Okay, for this mock exercise, we're going to take a look at Arneson Corporation. We're actually going to do record an acquisition of an asset, and then we're going to actually do some depreciation calculation, and we're also going to show you impairment testing and disposal of an equipment. So in this question, it starts with the company buying land and building on May 1st, 2008 for $385. So this is what we call a basket purchase. Now, of course, we have to record the land and building separately because land we don't depreciate, but building we do. Now, the company paid $115,000 cash and signed a 5% note payable for the remaining balance. So the difference between $385 and $115 would be the actual balance of the note. Now, it says at the time it's estimated that the land was worth $150 and the building was worth $235. So if we add the two together, it should add to $385. So the what they paid for is actually equal to the estimated values for both land and building. The building was estimated to have a 25-year life and $35,000 residual value. That's the information we're going to need to calculate the depreciation expense. And the company has a December 31st year end, so which means that we have to do a proration of the first year of amortization. Now, they use a single diminishing balance, which means that it's basically a declining balance method, not a double declining because it's a single. And they use that for the building. And these are the following transactions in 2008. So let's start with the first transaction. So the first one is on May 1st, 2008. We're going to debit land for $150, which is the estimated value of land, and we're going to debit building for $235. We're going to credit cash for $115, and the remaining difference will be in notes payable for $270. Because in the question it says we paid $385 in total. Now, if what we paid in total was, let's say, $350,000, then we're going to prorate the $350 based on the relative estimated value for land and building. So in this question, the estimated value for land and building equaled what the price was. But if in a separate question, if the price that they paid was a bargain at $350, then we need to be able to use the relative fair value of the land and building separately, and we're going to use that to prorate the $350. Okay? So in case you get a question like that, then that's what you need to do, is you would have to use the relative estimated fair value of both land and building and use that to prorate the $350,000. But that is not the case in this question. Now, we're going to calculate, first of all, the December 31st depreciation expense. So first, let's calculate the building. The land, there's no depreciation, of course. The building, we're going to use a diminishing balance, a single diminishing balance. Okay, so the rate is 1 over straight line, which is 1 over 25 years, is 4%. So it's the building is $235 times 4%. But because we bought it on May 1st, we're going to prorate to 8 over 12 months. So that's our first year of amortization. So debit depreciation expense, credit accumulated depreciation. Okay? Now, we're also going to record the interest expense because we have a balance owing on the note. The note is $270,000, notes payable, and we're told that the note is 5%. And of course, the note was only outstanding for 8/12, so we need to record an interest expense of $9,000. So this is the depreciation calculation, right? So we're going to debit interest expense, $9,000, credit cash in this case because it's payable at December 31st. We're told it was paid on the balance owing. Okay? Now, in 2009, we paid $225 to have the furnace cleaned and serviced. And that one we have to decide, is it enhancing or better, is it a betterment, or is it just a repairs or maintenance? And in this case, given the fact that we're just furnace clean and service, that's typical expenses incurred. So that one there we have to expense. Okay. So in 2009, we have February 17th. We're going to debit repairs and maintenance. We're going to credit, in this case, cash. And then it says record the annual depreciation on December 31st. We're also going to record the interest. And we're going to test for impairment. So I'm going to come back to the test for impairment in a minute. Okay, so let's first do the depreciation. So on December 31st, we need to record the depreciation. So we know that the net book value is $235 minus $6,267. We're going to multiply that by 4%. Gives us $91.50. So we're going to debit depreciation expense. Credit accumulated depreciation. And we're also going to record the interest expense. Again, $270 times the interest rate of 5%. Okay. And it was outstanding for the entire year, so it's $13,500. So debit interest expense, credit cash. Okay, now let's go back to the question. The question specifically says that the land and building was tested for impairment on December 31st. And we found out that the land had a recoverable amount of $120 and the building of $240. So, recoverable amount let's call it RA for the land, according to the question, was $120 and building it was $240. We're going to compare that to the carrying value. The carrying value for the land was $150. So now you've got a problem, right? You've got an impairment because the recoverable amount is less than the carrying value. So you have an impairment. And the answer is yes, we have an impairment, and the amount is $30,000. Now, for the building, we need the net book value. How did we determine the net book value for the building? Well, we had $235 minus the depreciation for 2008, which was $6,267, minus the $91.50. So the net book value of the building is $219,583. And because the recoverable amount is greater, there is no impairment. So we only have one issue of impairment. Recoverable amount, although given to us in this question, is defined as the greater of fair value less cost to sale and 2, value in use. And value in use, so fair value means how much you think we can sell it for, less the cost of selling, so commission, right, cost. And value in use is basically the cash flow that we're going to generate from using the asset, and we're going to present value that cash flow. So in this definition of recoverable amount, although it's given to us in the question, these numbers should represent the greater of these two numbers. So they would have actually done the work and calculation and assessment to determine what the recoverable amount is for the land and building. But in this case, we do have a write-down, which is the land. So we need to debit the impairment loss. And this is called impairment loss land, $30,000, which is the difference between the 150 and the 120. And we're going to credit land. Okay? Now, let's continue on. And we're told that in 2010, they sold the land and building for $320 cash, $110 for the land, and $210 for the building. And we need to split that because we need to calculate the gain or loss, don't we? Okay? And we had to actually pay the notes payable and interest owing. So first of all, we sold it on January 31st, 2010, which means that we still need to amortize 1 month, right, for the building. So first, we need to amortize the building. So the net book value of the building is $219,583. Now, how did I get that? It would be the $235 less the $6,267 less the $91.50. So we would have had to determine the net book value, and that gives us $219,583 times 4% times 1 over 12, because we only used the asset for 1 month, and that gives us $732. So we're going to debit depreciation expense, credit accumulated depreciation, $732. Then we need to calculate the gain or loss. How do we do that? Well, what was the actual proceed? So the proceeds of disposition was $320. What was the net book value? Well, we know with land it was $120 because we had $150 less the $30 impairment loss. And for the building, we had a cost of $235, and the accum was $16,149, which includes the $732. So net book value is $218,851. So the total carrying value of the asset disposed is $338,851. We're going to compare that against the $320. We have a loss on disposal of $18,851. So now we're ready to do the journal entry. So first you need to calculate the loss. So we're going to debit, in this case, we're going to debit cash, $320. We're going to credit land, $120. We're going to debit loss on disposition, on disposal of 18,851. We're going to debit accumulated depreciation for the building, and we calculated with 116,141 and 149, sorry. And we're going to credit the building, the cost of the building, which is 235. So this journal entry is the disposal entry, and they all came from this calculation. Okay, so we had to do this calculation to be able to do that journal entry. And then it says on February 1st, we finally paid off the loan. So we need to first of all calculate the interest. So the interest expense for the two, right? So it will only be for 1 month because it was February 1st, right? So it's 270 times 5% times 1 over 12 is 1125. So we need to debit interest expense. We're going to debit notes payable for the principal amount, and we're going to credit cash. Okay? Now, Part B says what factors may have been responsible for the impairment. So remember, we had an impairment in land. So, right? So they're asking us what factors would have resulted in the residual amount being less than. Well, there are a couple of reasons. It could be a contamination found in all of the surrounding property. That could be the reason why the land could have a residual value amount less than the carrying value. Okay. It may also have been the fact that it could be a property that they were willing to pay a little bit more for perhaps a future expansion that they had in mind. But again, that expansion may not have further developed in their strategy. So what happens then, the value of that land may not be the same anymore. Okay? So there are many different reasons why there's an impairment. An impairment just basically says the value in use or the fair value less cost of sale may not be may not be as high as what we originally paid for. Now in C, it asked us, assume instead that the company sold the land and building on January 31st for $400,000 cash and $160 for land, $240 for building. Record a journal entries to record a sale. So here in Part C, the calculation doesn't change, right? So if you remember, we had to update the land and building. We had to figure out the net book value. So here we're going to debit cash, $400,000. So instead of $320, we got $400,000. We're still going to credit land for $120. We're going to credit building for the original cost of $235. We're going to debit the accumulative depreciation for the building, $16,149. These have not changed, but now we have a gain. And the gain on sale would be the $400,000 less the net book value of carrying value of $338,851 for both land and building, and that should give us $61,149. Okay, so that is the entry for Part C. Thank you.